Hello, chart watchers, and welcome to this Friday, July 27th Market Watchers live show with your hosts, Tom Bowley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we've got a number of big companies reporting after the bell last night and also this morning. And at this point, the Dow Jones Industrial Average down 9 points. The S&P 500 at its low of the day, down about 8.6 points. The NASDAQ taking a big brunt of the selling today, down 64 points. The Russell 2000 underperforming once again, breaking to lows that we hadn't seen since the first week of July, currently down 24.5 points. The 10-year Treasury yield, after rising, getting close to 3%, has pulled back now at 2.96%. Volatility rising off of its recent support level, just below $12. It is up about 4.78%. Technology having a very rough day, down more than 1% today. And I've listed several of the big name companies that have reported either last night after the bell or this morning. We've got Intel currently down about 8%. Amazon, although it still is up probably about 1.7% or so, it is down quite a bit from its opening gap higher. Twitter following Facebook way, way lower today, down almost 20%. And then in the energy space, both Exxon and Chevron reported this morning. Both missed estimates badly, earnings per share estimates anyway. Both gapped down, but you can see that both have recovered quite a bit, with Chevron now back in the green for the day. Erin, it's been kind of a crazy week with all the earnings and everything coming out. We got another big week next week. Apple comes out. But how are you doing this Friday morning?
I'm doing great. It is Friday, so it's hard not to be doing great. And of course, I'm going to be leaving for my little mini vacation next week. So, hey, I'm in a great mood.
And what are you doing? This is for your anniversary?
Yes, 1 whole year. I don't know if everybody remembers when I disappeared for my honeymoon for quite a while. But yes, it's already been a year. I can't believe it, Tom. So yeah, we're going to go and enjoy ourselves in the same place we got married in San Clemente. So it'll be nice.
Cool. Congratulations. And that comes from everybody, I'm sure, watching the show. We have a great trip next week. So what do we got going on in the market today? What are we going to do?
Okay, well, let's first look at that schedule that's coming up. And, we've got Mary Ellen. As I said, I'm going to be out. So Mary Ellen is going to graciously is filling in for me. You've got your August seasonality report, going to let everybody know what to expect going into August. And when I get back, I'll do the Decision Point monthly review. All those monthly charts will have gone final, and I'll give you the long-term outlook on August 1st. And then Bruce Fraser is going to be coming in. Look forward to getting more Wyckoff advice. And then finally, mark your calendars or sign up more likely. August 10th and 11th is our ChartCon 2018, our virtual conference. Go check it out. Today's agenda, we're going to start off with sector analysis. Inside the lines, one of our favorite segments to do, pits Tom and I against each other a little bit. And Stanley Black & Decker will be our first symbol for the 10 and 10. And finally, we'll wrap it up with my sentiment update. I'll let you know what is going on and how investors are feeling and what they're doing with their money. So let's go ahead and get it started. I know with all these earnings, it's just going to be lots and lots of headlines. So
yeah, we got a bunch going on today. So let's go ahead and jump right in first with the 10-year Treasury yield. So what we've got today is 10-year Treasury yield at first, approaching that 3% level. And once we broke above the 20-day moving average, that was really the first target to look for. That's where the reaction high back in early June, when we saw selling in the Treasury market, the yield rising, it stopped right at about 2.99%. And so when we broke above the 20-day moving average, I was looking for an initial push back up to this 2.99.3% level. Today's high, 2.988, getting pretty close to that level. So if we're going to see money rotate back into treasuries, it would seem like this would be a technical level to watch. And of course, as money moves back into treasuries, treasury prices go up, but yields go down as the prices go up. So that's, maybe in the short term, that's what I'd be looking for here, backing off of this yield resistance near 3%, and then look back down to these moving averages which are down closer to 2.90%. But while that's occurring, as the money rotates back into treasuries and yields fall, we could see some weakness in stocks. And that is certainly the case today, as we're seeing a lot of selling since the open. Let's take a look at some of, actually, I didn't give you the economic news. There was some economic news out today. Q2 GDP, that's pretty big news. The first reading came in at 4.1%. The market was expecting 4.2%. It is the strongest growth in 4 years, even though we did miss the estimate. And then at 10 a.m. Eastern Standard Time, July consumer sentiment came in at 97.9 versus 97.1. So a little bit of a mixed bag there in terms of actual numbers versus estimates. But let's take a look at some of the key indices. I've been talking a lot about the Russell 2000. I'm still expecting some additional relative strength in the second half of the year because I do think the dollar breaks out, but that is not the case right now. Earlier this week, we saw the Russell 2000 threaten its earlier all-time high, which was established back in the third week of June and then retested in the second week of July, right about 1707 area. I think the high on Tuesday got up to about 1707 before we started backing off. Now, I originally looked at this pattern as an uptrend, a cup, and a handle back to the 20-day moving average. But as we moved up, we did not get the breakout, and we have continued to meander lower and actually taking out these prior lows. So I would no longer consider this a cup with handle pattern. Instead, I'd be looking one of two patterns maybe to develop. Either we put in a higher low than what we saw back here in June and perhaps begin to consolidate in an ascending triangle. This would be point A, B, C. Whatever low this is would be D as long as it's above that prior. And then an E would be a breakout above the 1707 level. That would be one possibility. We don't know if that's going to establish until we see what kind of low we put in on the Russell 2000. The other possibility is if we don't put in a low that's above this prior low, then I would be watching the 1640 level pretty closely because we could simply have a rectangular consolidation pattern. And that would be the result of going back down and testing the price support that we established back in late June when we pulled back and held the low there. And also prior resistance at 1640 on this breakout becomes support. So I think 1640 would be a big level on the Russell. In my blog article this morning, I was looking at maybe 1675, seeing if we could hold, or maybe that was yesterday's blog article. I was looking for 1675 to hold, but currently we're at 1670. If we continue to weaken into the close, I think we need to watch to see what kind of pattern develops here on the Russell 2000. Let's keep moving on. How about the NASDAQ 100, the NDX? We've got the NASDAQ 100 pulling back, hitting the 20-day moving average. I think back when we had the 50-day test here and the PPO centerline test, that reset everything. And now on this push back to the upside, the PPO has been rising. I think a normal pullback at 7,300 or thereabouts is nothing to be to grow too concerned about. If we break below 7,300, then I think we've got potential issues because at that point you've got the 50-day moving average down just below 7,200, and then the next key price support level will be just below 7,000. So I'd like to see it on a closing basis, the NASDAQ 100 continue to hold 7,300. That'll be worth watching. The S&P 500. Let's pull this one up. Probably heard of this index before. It's trying to hold on to not only its 20-day moving average, but if we go to an hourly chart, we're still well above that. The S&P and the Dow Jones, the large multinational companies, after underperforming for a while, are actually outperforming. And the Dow looks best of all, which I'll show you in just a minute. This one in my blog article this morning, I was looking to see if we would hold this rising 20-day moving average. Typically, when you've got the PPO rising, you pull back and you hit that 20-period EMA, it holds or thereabouts. You can see back in second week of July, beautiful move up. PPO was great. Here we went just slightly below that 20-hour moving average, and then we broke to new highs. And then as we put in these highs, you can see the PPO never followed suit. And eventually we just had sideways consolidation. We reset the PPO back at the center line, got the 50-period test, and then we started rising again. So with the current momentum pointing higher, I would expect the 20-day to hold. If we failed to, then I'd be looking down at this price support level at about 28.15. That would be the next key area. The Dow Jones, pull up this one on an hourly chart as well. Kind of looks like a flag to me. Nice uptrend followed by flag. Completely different look than what we were seeing on the other indices. So I think the Dow, at this point anyway, in the short term, is certainly the place to be. These stocks are not getting hit very hard. It's many of those higher growth tech stocks that led the market earlier over the summer that are starting to show weakness now. The dollar continues to consolidate. This is something I'm going to watch for future trading strategy considerations. I think we're just consolidating. We had a negative divergence on the UUP. We're getting close to centerline support. We're down close to the 50-day. I think we just consolidate and then we break out above the recent high. But if we don't, that could change some trading strategies, and we'll keep you up to date on that. Let's see. Twitter came out with earnings. Wow, what a mess here. One day after Facebook dropped a bomb, Twitter drops a bomb. One of the key components here, Twitter actually on the top line beat by about 2% above expectations. Earnings per share, they matched expectations at 17 cents. But the big problem with Twitter is analysts were expecting 338.5 million monthly active users, which would have been higher than the 336 million last reported. And instead, Twitter came up short, 335 million active users, monthly active users, which actually showed a monthly decrease when analysts were looking for an increase. And I think that spooked traders more than anything, the fact that the monthly active users actually decreased from month to month. And so you can see Twitter on the heels, and they also just matched expectations on the bottom line. And in this market environment when you're being priced for perfection, like Twitter was, I think there were a lot of traders looking for a beat here. Didn't get it. Lower monthly active users, and then we get this. Let's take one quick look at the semiconductors. The semiconductors, you can see yesterday got a big lift from AMD, Advanced Micro Devices, beating its estimates and having a really bullish forecast. Well, today it was Intel. Intel came out with their earnings report, and Erin's going to go over that with you in just a second. But Intel did miss or had some guidance issues going forward. And actually, they raised their guidance, revenues and EPS. But for some reason, market not a big fan of Intel. Erin will take a look at that chart for you in just a moment. But the semiconductors, after having a pretty nice lift yesterday with AMD and testing key short-term resistance, fell back and have basically given up all of yesterday's gains. So, Erin, I'm going to let you take it away. I know you got some upgrades and a few earnings reports to go over.
Yes, indeed. Quite a bit of charts to look at here.
I was surprised with that Intel report because they did come out with some pretty good numbers, but for whatever reason, market really not a fan at this point.
Right. Well, we might as well start right there. PMO sell signal on this big gap down. Seems like, really, Tom, when we're looking at all these earnings that, a lot of these big name tech companies, have just, they're failing as far as, the earnings are coming in lukewarm or poor. And it's just, we're getting all these gap downs. Yeah. So I'll be interested to see what you have to say during our sector analysis portion. All right, so here is what I would say is a good spot to look for support. And obviously, we're right now trading below that area, which is certainly a problem. So if we bring it down just a little bit more to line up with these lows and these tops, we are close to some support here. I would say after that, we're getting all the way down to $42. So I would be a little bit cautious about Intel right now. I think with all of those stocks that have gapped down, Facebook, some of the big names right there, Twitter, I think did as well. So Netflix from before, there's a lot of problems out there. And with all of these gap downs, I think bottom feeders should be interested, but beware at the same time. All right, let's see. Yes, so in particular, Intel, just so you know, I didn't read the revenues beat 16.96 billion versus 16.78. Earnings per share was up $1.04 versus 97 cents. And they raised their fiscal year 18 revenue and earnings per share guidance. Yet we have this very ugly chart. So it seems that to me that tech is starting to really fall out of favor. All right, let's look at First Solar. This was another one that reported earnings, and we got a big problem on revenues, 309, or is that a typo? Let's see, because that sounds like a lot. 309 million versus 509.
Yeah,
and earnings, yep.
They missed by a wide margin.
Yeah, big time. And then earnings per share, 46 cents versus 2. So issues in line guidance for next quarter. So, another one, big gap down. The PMO looked pretty healthy here, really, because prices were really moving mostly sideways, and you could see we were getting some momentum kicking up here for the PMO. But wow, 50 below the 200 like this, you do have to beware of your signals not really coming through the way you might want to see them and expect them. But, looking here, I don't have it annotated, but about $45 looks like the strongest area of support. I'd be looking toward that area before we see a rebound here. Amgen, that's an interesting one as well. They lowered their guidance. I'm sorry. They had revenue 606 billion versus 5.72 billion, earnings per share 383 versus 352, and everything else was in line. So we're seeing still a little bit of a decline here on Amgen. We're near those highs already, so I think we were kind of in line to have a pullback here. Anyway, I would be looking for obviously a punch above that particular area of overhead resistance. You could even draw it back here to where we had, those highs earlier in July. And, we're coming down already to test this area of support. So if we can hold on to that support, might be a nice ride back up toward those highs. But I don't like the PMO, so I know that I wouldn't be jumping in. Amazon, of course, big one. All right. Amazon seems to be doing just fine. Revenues, though, 52.88 billion versus 53.45 billion. But earnings per share, $5.70 versus $2.49. Nice for Amazon there. Their revenue guidance for Q3 was lowered, but the operating margin increased, and it looks like investors, despite being somewhat spooked by tech, seem to be pretty happy here with Amazon, and it continues to make all-time highs. It's up 1.5% today. The PMO is really acting a little fishy here in overbought territory in the near term, so that did have me a little bit worried. But this might be the one safe area to sit in technology. Again, they're doing far better than we're seeing on a lot of these others. Starbucks, Tom's favorite. PMO buy signal right now. When we look at what the earnings were, revenues 6.31 billion versus 6.25 billion. Earnings per share 62 cents versus 60. And they upped their Q4 earnings per share guidance to 68% or 68 cents versus 63 cents. So a pretty good look here, and we can see that investors like it. We've got a nice 1.87% increase. And really, if I had looked at this chart yesterday, I would have been pretty excited about a possible flag and the PMO buy signal that was already intact from very oversold territory here. So Starbucks, I think, looks like a pretty good place to look at. I would watch that $53 level, though. That could pose some difficult resistance just based on these lows back here in October, November, and especially that February low. All right, a couple of upgrades for you. I'll just look at these very quickly. Exalta, an upgrade. I like this one only in terms of actually a shorter term trade. And that's because we've been in this trading range for so long this year, and we're now near the bottom of that range. You could set a pretty good stop here right at those lows at about, $29.50. And you have a lot of upside potential if we can see it move to the top of that range. An upgrade is certainly welcome. Mobile Mini, big time decline yesterday, but on this upgrade, we are seeing some resuscitation with a 7.39% move to the upside. I saw an ascending triangle. We got that breakdown as expected, and it did go down about the size of the pattern. So that could be all that is necessary, but the PMO is still looking pretty ugly. I would, we're looking at having beat out right now these lows that we saw back in April and May. I think that there's some possibility, but I'd like to see momentum shift a little bit, shift even more to the upside. Getting a nice bounce off of support here for NXP Semiconductor also has the upgrade. The PMO is pretty ugly here, but again, we're bouncing off some pretty important support here. So I would keep that in mind. And that's all I have for upgrades, downgrades, and earnings charts. How about we move into sector rotation, Tom?
Sounds good.
All right. I'm going to start just real quickly because I wanted to show everybody my sector rotation candidate here. If I can figure out how to get to, there we go. And window, there we are. Okay. Let me see if I can get this much bigger for us all here. But this is my sector rotation chart that I show all the time that gives you an idea of what rotation means and the economic cycle, what you're supposed to expect. Your defensive areas are near the top here as you start to contract, and then you're going to start seeing the cyclicals, tech, all of these more aggressive sectors starting to do well if you're in the middle of expansion or if you're in an early expansion. So these are the things that we look at as far as defensive and more aggressive sectors. I'm going to pass it to you, Tom, if you don't mind, since I think the aggressive sectors are probably the place to go first.
Okay. Let's see here.
Don't want to throw you off, but
okay. Well, we got the S&P 500. The first thing that I would do is take a look at the long-term chart of the S&P 500. It's been going higher for the last 9 years. So this bull market's been going for a long time. So one of the things that you really want to take a look at is to see, as the S&P 500 goes higher, does the money continue to rotate into aggressive areas, which should benefit more from a strengthening economy and growing earnings per share in S&P 500 companies. So there is the start. Now, what I would do is simply go to the bottom of this under the indicators, and let me show you how you can set this chart up. All right, what you could do is put in the 4 aggressive groups. So the XLK versus the S&P 500. I'm going to leave that below the chart. I'm going to put in a height of 1.0. And anytime I use relative charts, I like to use a solid line rather than candlesticks. Otherwise, it just gets really noisy and doesn't really offer anything. The XLK is the first one. The next one I would look at is the XLY. And again, set these parameters. I'm just pulling this up here so that you can see how you can set this chart up. And by the way, I've gotten rid of everything else. I've gotten rid of the PPO. I've gotten rid of the RSI. I've gotten rid of moving averages. I'm only interested really in just seeing how these different groups are moving relative to the S&P 500. All right, and then the final one I do is the financials. So those are the 4 aggressive indexes or sectors that you can look at relative to the S&P 500. All right, make this chart bigger so that we can see these lines a lot better. I'm going to make it much bigger. Let's try this. Okay, now as you're looking at this, you can see here's the S&P 500 going higher. Here's technology on a relative basis. We've seen a little bit of weakness, and Erin alluded to that earlier with some of these earnings reports that have come out. But I think it's pretty clear that technology on a relative basis is doing pretty darn well as the S&P 500 moves higher. In fact, this isn't just telling us that technology is moving higher. What it's telling us is that it's moving higher at a faster rate than the S&P 500. It's outperforming. When the XLK $SPX is rising, it's telling us that it's outperforming the S&P 500. When it's pulling back like it did in the second half of 2012 and into 2013, that's when it's underperforming. So I think it's pretty clear that we've got an outperforming group in the technology area. Then we move on to consumer discretionary, which had gone sideways for 2 years. And then toward the end of 2017 and into early 2018, made a breakout and continues to trade higher. I think the XLY versus the S&P 500 looks awesome. Then we take a look at the industrials. Yes, 2018 has been rough. We've got trade wars. We've got a rising dollar. We got a number of things that are hurting some of the multinationals, the big multinationals in the industrial space. But I still see this as a move to the upside. Notice the breakout back in the beginning of, or toward the end of 2016, right around the election time. Remember, that's when the industrials and the financials took off. We took off above 2.5 years worth of consolidation. And if you notice the recent weakness, that relative weakness went right to the area of the relative breakout, and we're turning up off of it. I think the XLI on a relative basis still looks pretty good. And then we come down to financials, and I think, again, the breakout in financials after multiple years of sideways consolidation, all the QE, the market trying to figure out what was going on there, the XLF went along for the ride, but it began to outperform in the fourth quarter of 2016, went back, tested the relative breakout level, and even as weak as financials were for about 3 or 4 months, you can see we did hold on to support, and we've started to turn back up again. Now, I see a little bit of problem in the discretionary area. We've been moving up so well here. I just want to point out a couple of things real quick. The XLY on the daily chart on the most recent high, negative divergence. If we pull up a weekly chart on the XLY, breakout, negative divergence. If we pull up Amazon, which is one of the big components of the XLY, higher prices, we got a negative divergence. Of course, Netflix, we've already seen some of the damage that was inflicted with their earnings report, negative divergence, higher prices, negative divergence. So I'm not ready to throw the towel in on the XLY. This is a group that's been a great performer for a while, but it might be time for them to kind of step back and allow the financials and the industrials to begin to move higher. So when I look at the XLY, this is my favorite ratio to follow to determine whether or not I'm bullish or bearish the overall market. I'm going to stretch this out over 10 years. Actually, I'm going to stretch it out 15 years. And let's take a look at the line chart, and let's do a weekly, and let's pull that up. So here's your bottom. Notice that this bottomed 6 months before the S&P 500. The S&P bottomed in March 2009. This ratio bottomed 6 months earlier in the fourth quarter of 2008. Notice at the top, when the S&P 500 topped in October of 2007, look what this ratio was already telling us. It was going straight down. We had rolled over. We topped back at the beginning of 2005, went sideways, but it was clearly in a major downtrend as the S&P reached its final high in October of 2007. Where are we at now? This ratio has been storming to the upside. I think this is very bullish. I think that we could continue to see a little bit of deterioration for a period of time. I wouldn't be surprised if consumer staples begin to outperform. They have been outperforming consumer discretionary for the past month or two. I wouldn't be surprised if this continues maybe for the next few months and this ratio continues to decline. But I think the overall picture here to the upside suggests that the S&P 500 can sustain this move to the upside. And I think sector analysis and looking at the rotation supports that theory that the market's going to go higher. So that's essentially what I had, Erin. So I'll send it over to you, and you can take a look at the defensive groups.
Yep, I will look at those sectors right now. Let's go over to... All right, I went ahead and pulled up that sector summary just to look at where we are here. When you look at where these sectors are and who's performing well. And I know, Tom, I think you looked at a little bit of that. What I'm really concerned about is when you start seeing those staples, healthcare, materials, when they start to move to that top of the range, that's when you start getting a little worried. I noticed a lot of people are asking in the chat room, whether we both think the market is rolling over. I don't see it just yet, at least via sector rotation. So I'm not too concerned about that one yet, but I would be watching those like we do. All right, so I wanted to look at first, I'm going to look at XLB. All right. So I did write about the materials sector anyway, so you may want to just go ahead and take a look at that article. I wrote it on, I think, Tuesday. I'm seeing some good stuff for materials. We have the PMO buy signal that came in when I wrote that article. We're getting ready to pop above this near-term price top. When I looked at it, I thought, oh, okay, well, maybe we had, that sort of a head and shoulders. But, those are reversal patterns, and we were already in a downtrend. So I kind of dismissed that. But even if you wanted to go ahead and say that's what that was, it failed, which is a good thing. We went out above this declining tops trend line. So I think materials are looking quite good right now. Let's look also at XLE. Here we go. We just got a PMO buy signal on XLE, and we're getting ready to pop up above some interesting overhead resistance right here at 78 as well. But 77, we're sitting right up against that. That's a really interesting area of overhead resistance if we can get back up and above that. We haven't quite reached the declining tops trend line yet here. So I like energy. I think energy is looking pretty healthy. Let's see, I was going to look at XLP, of course. All right. And this is the staple sector, which I know you did talk about briefly here. I'm going to get rid of some of these old annotations I have to clean this up just a wee bit and make it a little clearer. All right. So right now you can see yesterday we actually moved right on above some very interesting overhead resistance here at these tops right here and right here. And we're trading above it. We've got a gap here. My only concern here, I think this still looks very good. The consumer staples, I think, still has some room to move. But when I look at those two bars right now, I get that sinking feeling of a possible island reversal. So I'd be interested to see if it's going to hold up on this support previous resistance. The PMO is rising, but notice it is very overbought right now. So there is a realistic chance that's what we could be looking at as an island reversal. 50 is still below the 200-day EMA as well. I'll go ahead and save those. Let's look at XLV, healthcare. All righty, I'm going to fix this. I want it to be bigger so everybody can see it properly. I thought I'd fixed that, but I didn't save it. And that's something you guys should remember. If you're using those custom settings, the slide bar, the toolbar, you need to save or annotate that chart, or the next time you go to it, it'll still have those old annotations on them. So think about that when you're doing annotations or when you're using those custom slide bars or changing some of the information. So here's these two tops that drew my eye first, and you can see that it became new support after what could have been considered a breakaway gap, maybe executing this flag that I think you could make a case for here. At this point, I would be looking for overhead resistance, of course, at that top. I think it's still looking pretty good. Healthcare is, we're still seeing a rising PMO. It is trying to top, though. So again, we'll want to watch that closely. But, we have a 0.75% drop just about, and that is going to certainly affect the PMO. All right, I think XLU was the other one I was going to take a peek at. Got a minute. All right, so I had written about utilities quite a while back. I was feeling pretty good about it. Of course, then we did end up with a little bit more move to the upside, but then fell back down below this support level that I had marked from actually a previous low back here. Now we're looking at what could be considered a flag, but it's kind of messy. So I'm not a fan of that analysis. I would be more interested in just this near-term overhead resistance. We got that PMO is turned over. We're on the sell signal. I think that we could be getting ready to see some problems here. Utilities is not in great favor right now. But I think there's still some possibility here. I know we're just about done here, but I want to get this in. I see this symmetrical triangle here. That is a continuation pattern. So that does suggest that we'll get that this upside breakout that we're already starting to see will follow through, and we continue to see a price rise. You know, everybody, like I said, weakness is seeming to appear in the market in terms of the fact that, you know, tech is starting to suffer here, and with these earnings reports scaring and spooking people. So watch that overhead resistance there for utilities. You know, if we start seeing that turnover in the market, this is an area that could benefit. All right, that's my sector rotation finish. There are the symbols we went over, which sectors we looked at. There is XLC. We don't have a whole lot of data on that just yet, but we'll probably be including that soon as well. Okay, inside the lines. You want to give everybody an idea of what we're going to do for inside the lines? Because obviously this morning when I was prepping, it was very funny because I'm not supposed to give Tom any symbols. And I did, but he promised he didn't look at them. So
not a problem. All right, inside the lines, what we do in this segment is we try to basically dive into the technical picture for stocks in the news. So of course, right now we've got earnings season brewing pretty solidly. So we're getting a lot of stories out there. But as you've seen, you know, we talked earlier with Intel having great numbers on top line, bottom line, seemingly raising their guidance, stock goes down. So it's more about reading what's going on in the charts than it is about reading the headline news. So this segment is really about looking at the news, but then really digging inside the lines on the chart to figure out, you know, whether or not a story is really bullish or bearish based on the market's reaction. So that's kind of how we're going to go about this segment. And I guess if you want to give me the first stock, Erin, I'll take a look at it.
All right. So it's actually going to be kind of a basket, but you can either do all of them now or we can flip back and forth. But I read an editorial piece from one of the major financial guys. Let's see, Ted Jenkins, CEO of Oxygen Financial. He's predicting strong growth in the tech sector, despite what we're seeing right now with, you know, the Facebooks and Netflix and Intel, all of these people who are in the tech sector that are having problems. But he says in three particular tech industries, he thinks there's going to be some major growth. And that would be in artificial intelligence, mobile payments, and cybersecurity. So I picked out a couple of those ETFs to look at. And the first one would be iPay.
Okay, so let's take a look at iPay. This is mobile payments ETF. I'm going to stretch this out a little bit. I happen to agree. I think technology is definitely a place you want to consider investing. The internet stocks obviously are having a really rough week this week, but outside of the internet, the other groups for the most part have remained somewhat unscathed. So let's take a look at the longer term 3-year weekly chart on iPay. And what I see here is continuing uptrend. Yes, there is a negative divergence. You can see the higher prices here continuing to move up. You got the lower PPO, but I would say over the past few months, this PPO has been rising. And as it's been rising along with price, check out the volume. There's been a lot of interest in this particular area of the market. So for me, the PPO, the MACD, you know, these momentum indicators are secondary to price and volume. And I like what's going on here. We've been seeing now for the past few years, very few moves below the rising 20-week moving average. So I think as long as this group or this ETF stays above its rising 20-week moving average, I find it very difficult to go against it. So I'm bullish iPay.
All right. Sounds good.
All right. The next one, you talked about this a little bit earlier, Erin, energy, and you liked the PMO that was rising. And I know that XLE relative to the S&P 500 was rising from March through May, but has been downtrending since. And two components, major components of the XLE came out this morning with earnings. XOM, ExxonMobil, and Chevron, CVX. They both reported disappointing EPS, coming in way below estimates, but they both responded pretty well after gapping down earlier today. And so my question for you is, I know you liked the XLE earlier. If you had to pick between ExxonMobil, XOM, and CVX, which one do you like better?
All right, so let's start with ExxonMobil. The first thing that's drawing my attention here is this rising bottoms trend line. And today, despite coming back up here, we did see a drop below. And when I draw a top here, it's a pretty clear rising wedge. And those are, of course, bearish formations. I have the PMO tops that are in decline as the tops are rising here. I have to say, just looking at this chart, ExxonMobil would not be my first choice at this point, but let's see what the other ones look like. So CVX was the other?
Yes.
All right. All right, this one I like a lot better. Look at what's going on here. I've got a PMO buy signal. I can already see this one is a lot healthier. Let's see, we've got really a trading channel here over the past few months rather than a rising wedge. So although it hasn't been that exciting in terms of a rising trend, I think it's in a safe zone here within this trading range. But when I see this PMO buy signal just now coming in, I know that it's coming off of a 2% rise, but the PMO had already bottomed and was already heading back up. And you could see the scooter is a lot more healthy. So I have to say, when I look at those two, that would be my first choice would be CVX, Chevron. And there was one other I think you wanted me to look at.
No, it's just those two. So
okay, good.
Sounds like CVX one.
So definitely Chevron for me. I don't know. What do you think?
Am I allowed to answer a question I gave you?
I figure. Just quick. You don't have to agree or disagree.
I like CVX. I think that the reaction was negative, as you might expect, looking at some of those numbers. But these stocks have been beaten up for quite a while, and I think the fact that they had bad news, gap down, and then you see a lot of buyers coming in, signals to me that maybe the worst in terms of news is behind these stocks, and the market's looking ahead. And I think that's why we're seeing a bounce. I think the market's anticipating more strength ahead, and I agree. I think CVX looks a little bit better than XOM.
All right. Well, let's get back to those tech sector industries. What do you think of the artificial intelligence and robotics? Bots is what I picked, BOTZ. And I know this one's often requested.
All right, let's take a look at bots. Well, we have been declining here. I'm going to, again, stretch this out. I'm just going to stick with the daily chart, but let's go out a couple years and see what's been going on. Try to see where technically you might find some additional strength. I mean, it made a huge run in 2017. We're talking about from 15 through the end of November at 25. That's almost a 70% return. And then made another last-ditch move in January, topping. So I think the group overall, if we take a look at the longer-term picture, I think is pretty healthy, but it's mired in this short-term 2018 downtrend. And I'd like to see that end before I would want to commit capital. So I think for bots, I would leave it alone for right now. I don't think that the enthusiasm is by no means over, but I think when you start looking at the channel that it is in, maybe connecting these recent lows, I think it's in a fairly well-defined channel, and the volume's been coming out. So I think the group is just kind of sitting on the sidelines, maybe as a momentum type sleeper. Notice that the PPO, the daily PPO, has not been above the center line in several months. That is, kind of like the poster child of a downtrending stock or ETF. So let's get the PPO above the zero line. Let's break out of this downtrend channel and then maybe start to figure out entry points for bots. Right now, I'm going to pass.
Okay, there you go.
All right, next up. Okay, for the second straight day, we talked about this earlier, but for the second straight day, Twitter sent an internet shock through the stock market, Facebook, of course, being the first one yesterday. So taking a look at the DJ, this is $DJUSNS. This is the Internet Index. Why don't you pull up a weekly chart and maybe take a look at where we might find a bottom in this group, because we are seeing a lot of selling in internet stocks based on Facebook and Twitter's reports the last 2 days. So any idea where we might see the bleeding stop?
All right, let's see. I did do my article on Facebook last night as far as bottom feeding goes. So let's think about this in that same sort of situation. So I want to make this fat because I want to look at support resistance zones is what I call it. So right now it's sitting right on some very important support, and we're talking serious support here. If we break down below that, now we're starting to really see some areas that could be really dangerous and a problem. I've got a PMO sell signal here, which of course I don't like. It's clearly something that we're getting off of that big gap down and the problems we're having with the earnings and such. So, I think right now we're at a critical point in terms of support. I don't suspect that we're going to see it. I wouldn't look at this as an island either. With a lot of these big gap downs that we're seeing, my thought is honestly, we're not looking at island reversals here. We're looking at breakaway gaps. So to me, I would expect to see more downside. Now, where would it be as far as the best support and resistance? I think this one is a pretty good near term right there. I could probably give up this one as far as a possibility. So if we don't hold this support, I think it's just absolutely critical we hold that 1700 support for this index. But given the earnings we're seeing, the problems being that you're not getting the subscribers or the kind of, platform interest on a Facebook, Twitter, that sort of thing. And they're really dependent on that. And so to me, there's only so many people who can have internet, I guess, and have these, there's only so much that they can do out there. But I think that as far as the internet index, probably healthier, but I'm still, I'm personally kind of moving away from tech. So
okay,
I'd say that's the story there. And of course, we already looked at Twitter quite a bit. All right, so the other one I had for you was the cybersecurity space. So CIBR. I mean, so far looking at those three, at least for me, I do like that AI area quite a bit. And I know we've talked about mobile payments, at least with, PayPal. And I think that it makes sense to me. I think those are both great. But what about cybersecurity?
Yeah, this one's been uptrending. The pullback here could be presenting an opportunity. I think that your biggest support level on CIBR is going to be this bottom that came in. First of all, we had a top at about 26. When we came back down, we put in a couple of bottoms here, 25.5, went into that 25.5 to 26 zone again at the end of June. So I'm still okay with the group, but obviously in the short term, it is running into some momentum problems. It's actually accelerating a bit to the downside. But I think that the key for me is going to be this 25.5 to 26 zone. So as it falls, I'm not interested really at this point to try and catch this little bit of a falling knife that we've seen this week. But I do think if it continues into the last week of the month and into August, I think that there could set up some pretty nice opportunities in this space if we get down into this area, because that has been a key area of price support. And so that's what I'd look for. Reversing candle, if you notice, both of these had long tails to the downside, meaning that intraday they were being sold off pretty hard, but by the end of the day they reversed. If we had something similar down in this zone, that might encourage me to get in to an area and be able to keep a very, very solid reward to risk trade in play. So it's a group I'd be watching. It's not a group that I would be jumping in at this moment, though.
All right, very good. I think that I agree with you that that space does not look quite as promising as the other two. So, maybe this guy was right, maybe he was wrong, but looking inside the lines, I have to say that cybersecurity does not look that healthy.
Yeah, this one I'm struggling with. And actually, I was struggling a little bit with that artificial intelligence because it has been downtrending throughout 2018 while we've had a very strong market in many areas of technology. And that area is just being shunned. And I'm a momentum trader. So I'm not interested in trying to call a bottom. I need to see that group start to strengthen and break out of that downtrend, that channel that I was showing earlier. And I think if it does that, then I think you got a group that maybe could run a little bit.
All right.
Okay, here is your summary for Inside the Lines. It's always a fun segment. I enjoy Inside the Lines.
Yes.
I mean, I am a fundamentalist because of my background. I'm a CPA. So the news means something. You know, the fundamentals certainly mean things. The earnings clearly do. But in the short term, from a trading perspective, as we showed, like with Intel and some of these other stocks, sometimes there's a pretty big disconnect with what you read in terms of earnings reports and what you see the next day in terms of a stock market reaction. And so that disconnect is where I think the technicals come into play.
Yep, absolutely.
Great.
For the record, I love doing all segments with you, Tom.
Oh, thank you. All right. 10 and 10?
10 and 10. I've been working, multitasking brilliantly, I would have to say. Let's go ahead. I'll bring up the RRG for everybody. And there we go. So what I like to do is, of course, based on study by Julius, who has developed these, we want to look for those stocks that are going in the northeast direction. But never fear, even if your stock is going in the wrong direction, it still might be chosen as one of those 10 stocks in 10 minutes to look at. Based just simply, I look at sectors, and then of course I do run through over here the ones that look interesting to me. So let's go ahead and get started. Go ahead and like some of the symbol requests in the chat room because the most popular will be the second symbol. But let's go ahead and get started, Tom, with Black & Decker, SWK, Stanley Black & Decker.
All right. First of all, I think this stock looks really good. I think that the downtrend seems to have ended. So let me show you what I'm talking about here. Here was a downtrend that Stanley Black & Decker, SWK, was in for several months, really throughout 2018, since we peaked in the middle of part of January. I could, let me go ahead and annotate and draw a channel. And all you do here with the channel is come over, grab this line, and on a Mac, I just hit the command in the left. Well, didn't do it there. Let me try it again. The command in the left clicker, and you can drag that exact slope anywhere you want. See how it's the exact same slope? So that's how you can draw channel lines. And I normally try to start with the candle body as opposed to the tail. Sometimes, you know, whatever makes it line up, you know, trend lines, channel lines, they're not exact. Everybody has different preferences. And so I wouldn't necessarily buy or sell based on a penny or two or a quarter falling inside or outside these channel lines. It's more just kind of a visual picture of what's been transpiring. And I think they're really good in trying to look for character change in a chart. But here you can see we were downtrending. I don't think there's any question over the course of the last year, especially the last 6 months, SWK has been in there under a lot of selling pressure. Every time we rally, we get another piece of bad news and continue lower. I think that changed. And I think it changed because huge volume coming in on the gap up. This was earnings related. This was a company that came in better than expected with its earnings, snapped that downtrend. I think it kind of fits into the multinational company theme right now, which has been working of late. And so I'd stick with what's working. We got a PPO that's crossed back above the center line. This is telling me that the bullish momentum is accelerating to the upside. We've broken out above that recent high that we established with earnings. Notice where we came back down to, the rising 20-day moving average. That's what I look for when the PPO is above the center line and accelerating. We tested it. We've moved back up. We've actually broken out. I think Stanley Black & Decker goes higher. I like the stock. I like the chart.
All right. Let's see, the most popular in the chat room would be NVIDIA.
Okay, NVIDIA, I think back at the beginning of June, we talked about does not like, historically, seasonally, does not like June and July. And we actually topped in June with a negative divergence. If you can't see that, let me highlight it for you. But here's what you look at. You look at these higher closes right there, and then the lower PPO. So that's just telling you that as price goes higher, what you expect is your short-term moving average to be pulling away from your long-term moving average. That's what normally happens in these uptrends. But once you start putting in these highs where the PPO is lower, then it's telling you that you're no longer showing that accelerating momentum to the upside in terms of price. So I think it's important to also look at volume. For instance, here on NVIDIA, as we made this breakout, notice that the volume was about 10 million shares. I could argue at that time that was average volume at best. So you've got a breakout, and then it turns out to be a false breakout because you don't sustain it with a negative divergence in play. And by the way, with seasonality completely turning negative for NVIDIA starting in June. June and July, I remember looking at this one, it had average returns for both June and July were like minus 4%, minus 4.2%, something like that, going back the last 20 years. The stock doesn't like the summertime, and technically we had a negative divergence. And so I think the stock's doing about what we should have expected it to do. I think longer term, NVIDIA still looks good. Maybe watch this trend line that's been established for the past several months, but maybe start right in here. I think that's a pretty key trend line. Certainly if you go below that late June low, around 235, you're going to be losing trend line support, be below your moving averages, price support. I think that's when things really would start to turn down. So I'm okay with NVIDIA right now. I think it's done what it's been expected to do, given everything as we went into the summer. But I'd be careful it loses about 234, 235 to the downside.
Okay. One that is taking a beating today, ETF, would be that biotech ETF. We haven't talked biotechs, I don't think, in a little while.
Which biotech ETF?
IBB. Sorry about that.
Sorry. There's a few of them. I just want to make sure I was getting the right one.
I just got a PMO sell signal, so I wouldn't be in there.
Yeah, what I would look for here, because you do have a negative divergence. So unless you get a reversal here, I'd be looking at the 50-day, which is the equivalent of gap support. Let me just pull this up. So there's the bottom of gap support. Here's the top of gap support. I think somewhere in here is where I would be looking for a reversal, assuming that we don't reverse today, because the group is definitely weak. I know Amgen was down, but trying to recover. There were a number of the biotechs that have been, built up and moving higher. But then you can see from this particular index, or this particular ETF, I should say, the PPO has rolled over at a time when we did actually have a higher close. And I'm drawing this line to the top of this hollow candle because the filled candle, actually the close is down here at around 118. So that is not where you want to be drawing the line. You want to be drawing the line to the close. But there, we did clearly have a breakout in terms of price. We had a lower PPO rolling over, and now we're failing on the 20-day moving average. It looks to me like we're heading back to this 112 to 114 area. And at that point, I actually think the IBB, especially if you get a reversing candle, I would be much more attracted to it at that point.
Okay. Let's see. Next. Oh my gosh, I love this company, but the chart is sadly pretty ugly. That would be Stitch Fix, SFIX. If you have ladies or men out there that are not high maintenance, they probably will love this. They will love Stitch Fix.
All right, let's take a look. Here's the price support. Now today, intraday, we're going below. We have come a little bit off the low. I actually like the stock if it comes back up and closes over about 30 and a quarter today. So it's got to make up another dollar. If it fails to, however, then I would be a little bit more concerned about a possible trip to test the recent low and the 50-day moving average, which is down below 27. So I think this afternoon's trading is going to be pretty big here on SFIX. If we can pull back, push back up, leave a long tail down here below price support, but hold it on the close, I think we have a chance to head back up and test that 34.5, 35 area. But if we fail to, then I think it looks like it's pointing to more the likelihood of more selling in the near term. So let's watch this one into the close today.
All right. Wow, this next chart I really like. I just got a PMO buy signal. US Silica Holdings, SLCA. Beautiful breakout coming in off of some strong support, successful test. What do you think? I think it looks Very interesting, as we say.
Yeah, it's starting to strengthen. I mean, I generally trade stocks that have a PPO above the center line rather than one below. I mean, anytime you're below the center line, it just looks, you've got your short-term moving average below your long-term moving average. So just by definition, you've got a stock that's been in a downtrend. But I would watch for a couple of things here. Off this downtrend, you could have a left shoulder, a neckline, a head. This could go up and struggle around 27 and a half, 28 and print the right side of a neckline. And then I think the key is going to be on a pullback. Does it hold that rising 20-day moving average? The other thing I would say today is what you don't want to see is a false breakout above this 20-day moving average. If you notice back in the second week of July, we were beginning to strengthen. In the intraday, we were up near 28, and it looked like things were good intraday. But by the end of the day, look what happened. We failed, and then we ended up going lower and putting in another low. So I think there are some mixed signals here, but what I would watch for is a possible setup for an inverse head and shoulders or a reverse. Really, it's a reverse head and shoulders off of a downtrend. But that rising 20-day moving average to me holds the key. And let's see again how we close today.
Okay. The next one, NEE, Nextra Energy. I don't like it. Rounded top PMO sell signal.
Yeah, they reported earnings earlier this week. At least I think they did. But yeah, I don't like this. I'll tell you, a sell signal. This is one of my favorite sell signals. And that is right there when you have a breakout intraday. Volume is just kind of so-so. Look at that long tail above the prior highs. And when it reverses and comes back down, look at the PPO here, which is much lower. That is normally a problem. And you could go back and look at what happened in April and again in May. Same thing. Trying to break out with a PPO that's in decline, and we ended up moving lower. That's what we're looking at right now. I think we're going to probably pull back to about the 164 level and then go from there.
All right. How about Andeaver, ANDV?
All right, ANDV, I'd be a seller right here at resistance. Let's see if it gets through. I like the chart. I think that, off of an uptrend, got a nice cup. I'd be looking maybe for a pullback and a handle to form. If it makes the breakout, you can always jump in, but this is the key area of resistance. So a pullback back down closer to 140 would not be a horrible thing. In fact, that would be an opportunity to get back in. I like the stock. I definitely would not be entering it here at a major resistance level, but eventually I do expect a breakout here in time.
Okay. Really in that same space, Valero, VLO. See if there's a difference there for you.
Well, we've definitely seen the change in character here. Positive divergence on the bottom recently. So I'll highlight that first here as we continued going lower. Prices continued dropping in here. And right there, we got a hammer on the bottom too with a tail that goes below these prior lows. That was a pretty good signal right there because you can see that the PPO is starting to turn back higher as we're putting in this low, as we're getting reversing candle. That doesn't always suggest a sudden surge to the upside and a major long-term bottom is in, but it usually suggests that in the near term, the selling momentum is fading. And instead of being confined below the 20-day, I start looking for a 50-day test. In this case, VLO went right through the 50, and look at the volume coming in. I'm a fan. I like this. I'd keep it on a watch list. I certainly wouldn't chase it after the huge move over the past few days. But if it pulled back to that rising 20-day, I think the reward to risk here looks solid.
Okay, in the financial space, Invesco, IVZ.
All right, IVZ. Another one downtrending. I'm going to go out a little further and just see if there's anything in terms of price support. We'll go back 2 years. Wow. Yeah, this thing's been under pressure for a long time. And I'll go ahead and annotate this because I do want to point out that when you see divergences, and I want to show you how good these divergences look. Every one of these lows coincided with a higher PPO, every one of them. But yet, and even you could even draw it now. But what has it done? It's done nothing. So technical analysis, and this is another perfect example too, by the way, of what I was talking about earlier, where you get a temporary move to the upside. So here we pull back. We go up with a PPO declining, that reaction high, I would expect the 20-day moving average to hold as resistance. It did. Came back down, put in a lower low with a higher PPO, and instead of stopping at the 20, it went all the way to the 50. And look at the PPO get close to the center line, and then we resume the downtrend. So I see a bunch of things here I just do not like on this chart. I think you've got a potential neckline here, left shoulder, neckline, head, right side of neckline. Here's your right shoulder, and boom, back to the downside. So I think you've got a head and shoulder top from 38 to 31 that measures down to 24. We haven't gotten there yet. I think it's got more downside. In a market that's going higher, this one just makes no sense to me at this point. I would pass.
Okay, and it looks like our final one, we haven't looked at airlines in a while. How about Southwest, LUV?
That's funny. If I had one more question for you back on the inside the lines, it was going to be about airlines because I really liked UAL. But let's take a look at LUV. The whole group, I think, has gotten better. We did turn at a key support level on LUV. Now, this is one that probably on a relative basis has not been performing great, but that was a pretty key low that we established back in September. You could even go back to gap support from here, pretty heavy volume back in January that never had filled, still hasn't filled. But 49 to 50 to me was pretty significant in terms of support. We were downtrending. We did get a positive divergence. So as you can see this low right here, and as we kept moving lower and getting closer to that support level, you can see that the PPO had turned up. And now, not only did we get to the 50-day, but we have put in a double bottom and had broken back out again to the upside. So I like it. I think that now that we've made this breakout above about 54, I'd use that as my support to the downside. I believe we're going to see LUV make another run now for $66. So I like Southwest. I like the airlines here.
All right, perfect. That was 10 stocks in just about 10 minutes. 10 and 10, we like to show you how quickly you can do that chart list and annotate. So here are the symbols. I'll have them up in the Market Watchers Live chart list, and you can find that at the top of all of our Market Watchers Live recaps and also the top of the blogs page. All right, we'll be right back with the final market update after this message.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.
All right, time for our final market update here on Market Watchers Live. Looking at the markets, definitely a bad day, and I can tell why people keep asking, is this it? Is this it? Is the market turning over? I would say it's too short a time frame to tell, but right now we see the Dow is in decline. S&P 500 really getting hit pretty hard here, down almost 22 points. NASDAQ and NASDAQ 100 continuing to free fall. And we could see with the S&P 400 and small caps, all are being hurt. Canadian markets did have a moment of truth where they were in positive territory. And it was actually making some intraday highs for the last 3 days, but has turned back over and has fallen a little bit above 72 points. Treasury yields are lower, currently reading 2.96%. UUP dropping, but moving sideways, consolidating. And gold having a pretty good day, actually, in a nice rising trend. Currently, GLD is at 116.08. USO oil was down earlier in the day and just in the last 20 minutes has really dropped and is now testing intraday lows back from earlier this week on July 25th. The VIX is rising sharply. As you can see with the market moving down so quickly, the earnings issues, we're starting to see some nervousness out there on the VIX, and currently it is reading just below 14. We're at 1367 for the VIX. And with that, I'm going to close out our final market update. And Tom, did you have a chart or two you wanted to add? I can't hear you.
I want to take a look at the financials here on this breakout or potential breakout. We tried to break out earlier, and this is always a problem. This is why, as groups, I mentioned earlier on the one stock that I really liked, I don't remember what, ANDV, I think it was. When it gets up to resistance, it doesn't mean, when I say that I would sell, it doesn't mean I don't like it. It's just that I think, when you get to a point where there have been sellers in the past, I assume that they're going to be sellers again, unless the stock or index or ETF or whatever proves me wrong. So the XLF here has been on a nice incline over the past 3-4 weeks after testing price support, but we can't ignore the overhead resistance here on the XLF at 28.25. We got up to 28.27 earlier, starting to reverse. I think it's got a shot now to move back to that rising 20-day moving average. Just wanted to throw this out there because if we were looking for an area of the market perhaps to lead and break out and really keep the market moving higher, I think financials were one of those groups. And so I don't like this reversal today on the XLF.
Yep. All right. Let's go ahead and I'm going to get into our sentiment update. So let's go ahead and take a look at the sentiment charts and what we're seeing right now. Okay, so really I'm just going to preface this with, well, first of all, the definition as far as sentiment. When investors are feeling especially bullish, that's actually bearish for the market, and vice versa. If investors are very bearish, that becomes bullish for the market. So it's contrarian. If investors are bullish, that's bearish. If they're bearish, that's bullish. So honestly, seeing this short-term turnover and concern about the market on a day like today, and even some issues going on short-term yesterday with some worry out there, that actually is bullish for the market in the very short term. So let's look at some of these indicators for sentiment. I'm going to start with the 10-day moving average of the put-call ratio for CBOE equity and OEX. And what I noticed first off is similar to last week. We are still seeing the put-call ratio in decline for the CBOE. When it is declining, that means we're seeing more bullishness. And so again, contrarian, investors are feeling bullish. That is actually bearish for the market. So as far as the put-call ratio goes, we're seeing some bullish movement here. And what we're going to want to watch for is when that bottoms, because when that bottoms, typically you're going to see a decline. So I don't have those marked right here. Let me go ahead and annotate so you can see it more clearly. All right, so let's look at a few of these market bottoms in the indicators. And I am just going to move them. If you're just watching price up above, then you're probably seeing some interesting information here. All right. So here are just the last few. I find that the stuff we saw, what we were seeing back during this parabolic rally, it was really hard to see a problem. The only thing you did end up getting when we had these extremes was sideways movement, neutral consolidation, but it wasn't a price rise. So when we were feeling especially bullish because we were in a parabolic rally, these extremes as far as to the downside didn't really cause that much in the way of tremors. But when, of course, we reached those levels, and we did have a point where we went up just a little, and then of course we hit that very difficult decline. You can see just last month when we bottomed that it came in right at the beginning of a pretty sizable decline. So that's why we want to watch this chart very closely. I'm watching to see how low it will go. Are we going to end up with a bottom that's higher or lower? But in general, I'm looking for those lows. So just keep that in mind. All right, let's look at the American Association of Individual Investors sentiment. This is a poll, a generalized poll that all investors, moneymakers, anybody can take on their website at aaii.org, I believe. what I'm looking for here, this is of course those fingers in the wind polls. So we're not looking what's happening with actual money. We're looking at what's happening in investors' heads. And I'm going to move you over to the thumbnail, because what I'm noticing is this decrease in bullish sentiment. You know, we're moving lower and lower. We are near some of the lows we've seen as far as bullish sentiment goes. And typically, when investors are feeling more bearish, and you can see a slight increase in bearishness, I'd like to see more of a spike here in the bearishness. That would really tell me to expect some upside action. But currently, we're just not quite there, but we are starting to notice investors moving more and more, less and less bullish, and just a little bit more bearish right now. But let's watch this number. We want to see that increase, and then we're going to look for that bull-bear ratio to move up into that 2 area, meaning that there would be twice as many bulls as there are bears. And when that happens, of course, that is going to be dangerous for the market. All right, let us go to name, National Association of Active Investment Managers. This is pretty much what the big guys currently are doing as far as their exposure to the market. And we didn't get much of a change. We're still looking at elevated readings here, and I do consider those neutral to bearish. Like I said, I can kind of pull it back a little bit with these guys, because they do tend to be on the right side for a few days after. At least lately, for sure. So I'm looking at elevated readings, and at this point, you know, with a reading of near 85, I would say this is still more neutral to somewhat bearish for the market. We'll want to watch this one also more closely, but I'm not getting huge amount of information from this chart. You know, they are elevated, like I said, you can see in comparison to a lot of other times, but they're not really at extremes just yet. You can see some of these really extraordinary extremes, including one back at the end of the year where it was the highest historical reading we had since we started tracking this. So we're not quite to that point, which would be extraordinarily bearish, but we're in bearish territory, neutral to bearish territory. All right, let us look at our RIDEX analysis charts. And I actually put one together that I know it's a little bit difficult to look at, but you know, when we will look at this one as well. But I thought it would be interesting just to look and get an exact feel for where the money flows are going for RIDEX. But I'll give you the quick and dirty here as far as what these charts are saying. This is not a finger in the wind. This is actual money. This is actual flows. Where are they going? Guggenheim has a basket of stocks that we use. They used to be called RIDEX, and they report how many assets are in each of their funds. So what we do is we tally up the assets in the bear funds, we tally up the assets in the money market funds, and then we tally up the assets in the bull and sector funds. And this tells us whether we're getting more bearish or if we're getting more bullish based on what's going on. So these were the arrows I came up with, but it's very hard to see what happens in the last week. So I want to bring up this chart in the short term just to give you a clearer picture. So when we started a week ago, readings were higher here, much higher, not even showing up on the chart. So we can see as far as the bear funds and money market assets go, as far as the ratio, the bear bull ratio, we are seeing a decline in that ratio. With assets, the RIDEX Bear Index funds, we're definitely seeing a rise. We're getting more money assets moving into those bear funds. And look at the money market, certainly an increase over the week. And assets for the bull sector funds, this is almost a straight line here. So we really haven't seen much growth in the bull sector funds, but neither have we really seen disappearance of those. So let's look at the bigger picture here. All right, there we go. So looking at that bigger picture, let's think about this. We're getting an increase in assets in money market and bear funds. What is that telling us? That's telling us that there's more activity on the bearish side. Cash is kind of a neutral place. Obviously, you're not in the market, out of the market, but I consider that more toward the bearish side. So if we are seeing an increase in bear funds and in money market funds, yet remember we saw flat to maybe a little bit lower bull and sector funds, money flow is going toward those the bearish side, and is staying about the same on the bull side. So I would read this is obviously we're seeing investors being a little bit more cautious, moving bearish by increasing their exposure on the short side rather than on the long side. But they're not decreasing their long side either when you're looking at the assets. So I would say overall, this is more of a neutral to bearish activity on the part of investors. And consequently, sentiment being contrarian, that would be neutral to bullish for our RIDEX chart. So I want to go ahead and call up, actually, I'm going to look at one more chart. And this is the climactic indicator chart. This chart I use in the very, very short term. One of the reasons I have candlesticks on there, because those are very short term patterns, basically. And so I look at this chart and look for what to expect over the next day or two. On the longer side, a week. So in the next day or two, where are we? Where is the money going as far as breadth? What's happening with that? And then also take a peek at the VIX. The VIX right now is still on the lower side of its average. Currently reading right now are 12.5. All righty. So the one thing that really struck me when I looked at this chart was the breadth here on new highs. How many new highs we had. And that tells me that there's a spike. This is a bullish spike, getting all these extra new highs. Well, if we're seeing bullish activity in something that could be considered a sentiment indicator, that would be bearish, right, for the market in the very, very short term. And we're still seeing high readings on the side of the advances minus declines. They're still on the upside. VIX, though, like I said, we're increasing. We increased it a little bit today, but we're not yet below that moving average line. And so I don't see the VIX as being particularly helpful in the very short term. So when I look at this chart, I'm looking at that excessive amount of new highs, and that's good. You do want to see new highs. That's going to prop up the market. But if you look back here, when we've had those spiky readings on new highs, things were getting very bullish, right? We saw, what was the follow through? Consolidation or a decline. And so when I look at that, it tells me that that's more of a buying exhaustion, that I would start to expect lower prices over the next day or two, maybe to start the week, lower prices. So that's what the ultra short term or climactic indicators are telling us. So let's look at the whole shebang here on our summary slide, and I'll give you the quick and dirty, as they say. All right, so again, 10-day moving average, put call ratio, bearish for the market. Okay, I'm going to concentrate on this side. AAII, we're looking neutral to bullish. We go to name and we're looking at somewhat bearish. You see a trend here? We've got the RIDEX ratio getting people more bearish, and that's bullish for the market. And now we have the VIX and breadth, remember, and I'm looking at that for a little bit bearish for the market. So when you tally that all up, we really have a mixed bag here. It's not telling us a whole lot to me at this point. I would look at our sentiment going into next week as more of a neutral. I don't think it's telling us that much. I would put a little bit more emphasis on the VIX and breadth. for the first couple days of next week. Like I said, I would be expecting just a little bit of downside. And then when I look at the rest, these are all that's neutral. If you're looking at somewhat bearish, I see more of a neutrality here when you look at all of these various setups as far as what the market should expect. So I'm going to conclude my sentiment report with just saying mixed readings in sentiment, unfortunately not telling us that much. So I'm going in neutral for next week, which of course brings up our poll.
Yes, it does. And let's see what everybody is thinking about next week. Lower.
Lower. Wow. Yeah, by quite a bit. That was what we were getting as readings last week as well. And well, let's see. What are we for the week right now? Going in, let's see, take a peek. I don't need to steal the screen. I'm just looking at what we're looking at as far as the weekly charts are concerned.
I think we're probably still up just a tad because we were up pretty nicely yesterday for the week. And
yeah, we're up 0.41% on the week currently, and of course that's going to finalize today. We'll see how that goes. But last week I was lower, the audience was lower, and Julius was bullish. So Julius is winning. As I told him, I said, hey, if we're all going with the crowd and you're not, maybe you're the right one because of sentiment being contrarian.
Well, I'm going to go against the crowd this week because I'm going to go higher, and I'm going to go ahead and just show us a quick chart here. The S&P 500, this is a 1 hour chart. So, we looked pretty good, and I thought, maybe we would hold this 20-day moving average. And we also had topped at 2830 before we broke out just a couple of days ago above 2830. So short term, we had a little bit of support there, and we broke down below that. But we hadn't filled this gap. And so the next level, as far as I see it, if we just annotate, would be to go down and fill this gap. So I do think in the short term, we have a little bit more downside. We almost filled it, it looks like, earlier. And we're trying to reverse off of it. Clearly, if we get a strong afternoon and we can reverse off this selling so far, I think that would probably point to maybe a reversal. But I think in the near term, I would be looking at about 2807 up to maybe closer to that 2850 area. I think that's a trading range that I would expect that will trade in. But who knows? We'll see. From a short-term perspective. If we lose 2807, that area, 2805, I would probably start to get a little bit more bearish in the near term.
All right. So you're going to go in as higher next week.
I'm going higher.
All right. Based on the sentiment, if I'm going to go sentiment-wise, I'm looking at mostly unchanged. Like I said, I'm not getting a real sense on either direction of leadership to the up or downside as far as bulls and bears. So I'm going to go into this week neutral. I always hate doing that because I feel like I'm straddling the line and not taking a stand. But sometimes when your indicators and your charts look a certain way, no need to force that. Just to take a side, a buy or a sell. So neutral, going in neutral.
Yeah, I was just going to say, I remain very bullish for the market going forward. I'm not at all, even if I was short-term bearish, that's all it would be, because as I pointed out earlier in the sector analysis segment, I think the market continues to rotate where it needs to rotate. So I think things look pretty good.
Well, we just showed you our upcoming schedule, but I did want to make a point of telling you that power charting with Bruce Fraser and Roman Bogomazov will be shortly, actually 3 p.m. Eastern. They're I think it's their second show, Wyckoff, all about Wyckoff. So you want to tune into Stock Charts TV for that.
All right. Have a good couple of days off next week, Erin. I'm sure that comes from everybody watching. I want to thank everybody for being with us today. Please remember to complete the survey as you exit. We do love to get your feedback. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Friday afternoon, everybody. Be safe this weekend. We'll see you back here on Monday. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.